Hello, everyone. I'm making a video to help us with chapter 3, the tax chapter. The tax chapter is one of my favorite chapters. As an accountant, I spend a lot of time doing taxes. So I'm very comfortable with taxes. And this is not designed to have you, this chapter isn't designed to have you become a tax professional. It's just an introduction into taxes. I wanted to let you know that I teach a tax class in the fall that is completely dedicated to taxes, where you learn like the ins and outs of all kinds of different things. But in this chapter, I'm just trying to touch on how taxes work. So the first thing I want to do, I'm going to go ahead and share my screen. And I want to give you guys a brief overview of how taxes work. So I'm just going to start from the very beginning. First, I should give you guys like the 1-minute spiel of how taxes work. And so all through the year, you get a paycheck. So if I were to hire one of you, and I'll use Will Branham because Will's in the class. If I were to hire Will to work for me and I was going to pay him, I'm going to pay him good. Okay. I'm going to pay him 20 bucks an hour and he's going to work 20 hours a week. We all know that if he works 20 hours a week at $20 an hour, that his gross pay is $400. But we all know that take home and gross pay are not the same thing. So his take home pay will be significantly less because of taxes. Other things are withheld from your paychecks, like health insurance premiums or retirement contributions. All kinds of different things are withheld from your paychecks. But the primary one, especially when you first start working, is taxes. So FICA is Social Security and Medicare. And then there's also federal income taxes and state income taxes that are withheld from your paychecks. So in accounting classes, I teach how to calculate net pay and how to do journal entries and stuff. But in here, what the basics of taxes. Okay, 1-minute explanation of taxes. Let's go. All through the year, money is withheld from your paycheck. So when you get your paycheck, there's money withheld for federal income taxes. At the end of the year, you get a W-2. The W-2 shows how much you made all year and how much was withheld all year. Then you go do your tax return, and your tax return calculates what should have been withheld. At that point, you look to see what you had withheld, and you either get a refund or you pay some in. And that's it. Okay? So that's a 1-minute explanation of taxes. You do the tax return to compute what should have been withheld. And then from there, you look to see what was actually withheld all year, and you either get some money back or you need to pay in some more. Okay, so it goes both ways. So the basic tax formula starts with your gross income, and then you subtract deductions for gross income to get adjusted gross income. Okay, this is an important number that we use in taxes a lot. AGI is the abbreviation for it, and so this one is abbreviated AGI. And so gross income is things like your wages. Okay, so the things that we're going to see in here are your wages from your W-2, interest, dividends, business income, gains and losses from sales of assets, alimony received. There's a whole bunch of different stuff that can be included in here. So, but it's basically anytime you receive money, you have to wonder, is it income or not? Okay. So if I today were to give each of you $1,000 because I like you, okay, then I would need 50 grand, because actually 52 grand, because there's 52 of you in this class. And so I would give each of you $1,000. When you receive that $1,000, you have to wonder, is that income? Do I need to include it? And the answer is no. Gifts are not income. Okay, so there's lots of things that are included in gross income and things that are not. Things that are, they're called exclusions. Okay, so let me go to, just to give you a little bit more background on this. So there's plenty of information in your book about things that are included in income and things that are not. Another example of something that is not is life insurance proceeds. So let's say that tragically you lose a parent, okay, and they had life insurance and the money went to you as the child. When you were, and I say child, like 20-year-old child, 30-year-old child, 50-year-old child. Okay, so my parents have life insurance. My parents are 63 and 64, I believe. I have to think about that. So my parents are 63 and almost 64. My dad will be 64 next week. There we go. So if one of them were to pass away and they had a life insurance policy that listed me as the beneficiary and I received $50,000, yay for me, super sad because I'll miss my parent. But that money that I receive is not income. It's called an exclusion, okay? So same thing with an inheritance. My sister-in-law, Janie, she lost both of her parents over the last, 5 years or so. And so she inherited quite a bit of money. Most of it was not taxable. Now, if you inherit something like an IRA, there's all kinds of special exceptions. And so sometimes portions of it can be taxable. But in general, inheritances are not considered income. So let's go to, where do I want to go? I'll go right here. It might take a minute. And so I'm going to look at my chapter 3 notes, and I want to just walk through a few things with you. It doesn't ever want to open what I want to open. Yeah. So what I want to look at are things that are considered income and things that are not considered income. So if you win a prize, that is income. If you win money gambling, that is income. If it feels like income, it probably is. And then there's this list of things that are excluded. So when we cover this in class as a group, a lot of times we go through these notes and I kind of fill them in with you as you go. These are the filled in notes. But one of the things that I ask them often are just like, tell me about taxes that you encounter regularly. Sales tax, excise tax on gas. There are sin taxes, S-I-N, like sinful behavior. Speaking of, Claire has her first communion tonight. She's the opposite of sinful today. So she gets to receive the sacraments. That's super exciting. So a sin tax would be something like on cigarettes or on alcohol. They can tax specific things like that. There's property taxes, like I pay real estate taxes on my house, and I pay personal property taxes when I tag my car. All of these are taxes. So a lot of students are like, it's ridiculous that we have to pay all these taxes. And my comment usually is, when your house catches on fire, do you like that you can call 911 and the fire department comes? I like that. I need to pay taxes because the fire department is funded by taxes. And that's just one minor example. I like that I am protected. Ooh, very good. Thank you. By phone? No, this is not Tor's phone. This is a gift for Jim Long. So, okay, thank you. So you encounter taxes all the time, and those taxes vary. I'm not anti-tax. Certain taxes go to pay for certain things. So we pay federal taxes to have military protection and all kinds of different things. We like roads to drive on. There's lots of reasons that taxes are in place, and I understand that it takes a certain amount of money, and the government has to get the money through some means, which is normally some form of taxation. So I want to get to the section where I talk about, these are just all different kinds of taxes. Okay, so gross income would be earned or active income. No. Wages, salaries, alimony received, business, farm, prizes, awards, gambling winnings. I think I mentioned both of those. Investment income is included in gross income. You can have passive income, like if you have a rental property and you bring in rent. So that would be another way that you could bring in money. Here's a list of items that are tax exempt. So these things are not considered taxes. If you receive a scholarship, it's not taxable, okay? There are certain exceptions. If you receive a scholarship for housing, it is considered income. But if you have other expenses, a lot of times we can get out of that kind of sort of. But scholarships in general, as long as you're using them for higher education, are not considered income. Child support received, not income. Child support is an obligation you have as a parent. So child support is different than alimony. Alimony is spousal maintenance is the proper term for that. And that money goes to take care of the grown-up. But the money that's paid to take care of children is not considered income to the person receiving it, and the person who's paying it cannot write it off on their taxes. So capital gains and losses happen when you sell an asset. And so my family knows that their tax transactions are free game because I talk about all of them in class pretty regularly. So my grandma just sold her farm. Okay, so last year, about now, in 2019, she sold her farm. She had bought it. I got to review all the stuff because I do grandma's taxes. She bought it way, way, way back in 1963 for $5,500. And then she sold it last year for $225,000. So there's a tax implication to that. She bought it for $5,000. It was like 40 acres and some buildings and stuff like that. And then she sold it for $225,000. And so we had to calculate the tax on that because that's called a long-term, because it's longer than a year, capital gain. So, this section that we kind of just talked about are all things that are included in gross income. So if you wondered, if you were doing the homework and you were like, are gifts taxable? You can just Google it and say the general rule is any gift is a taxable gift. But what they're talking about here is, so does the receiver of a gift pay tax? And the answer is no, they do not. And so gift taxes are a special category because basically I can give anybody I want gifts. I can give each of you $100,000. Now don't hold me to that because I'm not going to. But I could give each of you $100,000. If I win the lottery, if I win the big lottery, I'll give each of you $1,000. All right, I can come up with 50. So now you have me recorded saying that. So if during this class I win the lottery, man, we're all in, okay? But if I give each of you $100,000, which I'm not going to, you still get to not include it in income. It's still free to you. But the person that gives it, which is me, I have to pay a gift tax. What's happening is I'm distributing my income and they only let me give $15,000 to each individual person. So if I wanted to give you 100, I would have to give some to you and then maybe give them to your parents and then they can give them to you, or I would need to stagger it over multiple years because I'm allowed to give each person $15,000 a year if I want. And then that number goes up for inflation each year. Okay, so you can always like research if things are taxable. Look for reputable sites. Like this answer right here is from the IRS's website, so that's probably a good move there. This is from H&R Block. It's usually fine too. Okay, so back over to my basic explanation of taxes. We have gross income and then things that are deducted from gross income. So remember how I said alimony received would be included up here? So if you are the payer of alimony, then you get to subtract it. Okay, other things that you get to subtract are traditional IRA contributions. So if you have an IRA that's a traditional IRA, then you're allowed to put $5,500 in there, I think. And you get to write that off on your taxes, okay? Other examples, the one that you guys will see most often is student loan interest paid, okay? There's all kinds of other ones in this category, educator expenses. So all these things are subtracted, okay? They get to be subtracted to get to the answer of AGI, okay? So, so basically the first line, they're almost all positive, but if you have business loss, then it could be a negative number here, or a rental loss, then you might be able to write that up here. So most of these numbers are going to be positive, and then we subtract all of these to get to your AGI. From there, you subtract out, so you subtract standard or itemized deductions. Now these are different from row 2. So the standard or the itemized deductions, not both. So itemized deductions, what you do is you add up all of your itemized deductions. If it's more than the standard deduction, then you get to take your itemized. So what we do is add up all itemized. Is it bigger than standard? Subtract. So you would just subtract bigger of standard or itemized. So you subtract the bigger of the standard or the itemized deduction. Now, in the past, that number for a married person would be around 12,000 is the standard deduction. So you would add up all of your itemized deductions. And so examples of itemized deductions would be things like property taxes, medical expenses in excess of 7.5% of AGI. So they don't want you just writing off some Tylenol if that's the only medical expense you had. So your medical expenses have to be significant. So in my pretend world, I make $100,000. I don't, okay? So I always have to make sure I say that out loud. So I do not make $100,000, but if I did, if my AGI was $100,000, then I would only be able to include itemized deductions for medical expenses if they were more than 7,500. So if I had 7,600 in medical expenses, when I added them all up, I would only be able to use 100 of it because only the amount in excess of 7.5% of my AGI. Okay, so it has to be significant medical for it to count. I have plenty of tax clients that have significant medical. If you live in a retirement home, a lot of times you're paying $30,000 to $40,000 a year to live in the retirement home. So those medical expenses add up quickly. But even my parents who medically have some issues, my dad's diabetic and they've had surgeries and stuff, even them, they don't have enough medical to be able to itemize. So you have to add up all of these. Other things are home mortgage interest, charitable contributions, like money that you give to Friends University or a church or whatever. You get to add up all of these things. So real estate taxes, state income taxes paid, gambling losses to the extent that you have winnings. So if you had winnings in your gross income of $1,000, if you can prove that you also have 1,000 in losses, you can go ahead and subtract those. So we add up all of these and then we compare it to the standard. If the standard is more, take the standard because you want to subtract as much as you can from your AGI because we're trying to get our taxable income to be little, okay? So you want the bigger of the number. And so if you add up all of your itemized deductions and it comes in, you're a married couple and it comes in at $9,000, you're better off taking the standard. But if it comes in at $29,000, then you itemize, okay? So the itemized deduction for individuals used to be about $6,100, $6,200, and then for married it's double, so like $12,400. But they doubled the standard deduction. So when you guys started researching, you guys are working on that discussion board this week. When you guys started researching the information on the new tax laws that came out in 2018, one of the big ones is the standard deduction doubled. And what that means is the standard deduction used to be around $12,400, now it's around $24,000 for a married couple. So when you add up all of these costs, now you have to have more than $24,000. They also added some additional restrictions, like the total of all the taxes couldn't exceed $10,000. So yeah, they put some additional restrictions, and there are more itemized deductions than just these. These are just some of the main categories, okay? So you subtract out the bigger of standard or itemized, and then you used to subtract out exemptions. So exemptions used to be about $4,000 for every person your income supports. But when the new tax law doubled the standard deduction, they eliminated exemptions. So exemptions used to be $4,000 per person your income supports. So I have a family of 5. So I used to be able to subtract 4,000 times 5, or $20,000 right here. Now it's 0. Okay, I do not get to do that anymore. They thought that was okay because they doubled the standard deduction. The problem I had was I used to itemize at about 22,000. So I used to get minus 22 here and minus 20 here. But now I get minus 24 here and 0 here. So that's bad for me. It worked out really well for some other people. And I understand that, you know, when tax laws are reformed, they're looking at certain populations and trying to benefit them the most. But as a middle income taxpayer, the tax laws were not beneficial to me. But they did other things because they reduced the rates and stuff. So there's that. So right now, exemptions are 0. And then this is the answer you're looking for, taxable income. So we're going to do wages and stuff, minus any of these gives you an answer, minus either the standard or itemized, minus 0 right now gives you taxable income. So this number is the number you use to compute tax. So this is the big answer, okay? That's the one we're looking for, okay? So if I were to show you an example, all right, I guess the answers are in here. So, okay, so let's just talk about Roberto. Roberto Gomez, you might know him, I'm not sure. So he was a student of mine last time I taught this class in person. So Roberto is a single dude. He makes $40,000 from his wages as a chef. He has an ex-wife that he pays child support of $4,000 a year and alimony of $2,000 a year. He doesn't have any dependents. Okay, so that must mean his ex-wife must claim the kids. He pays student loan interest of $150. He had $3,100 withheld from his paycheck for federal income taxes. What is his AGI? Taxable income, tax liability, and then does he get a refund or does he pay in? So his gross income, when we look at this, he received money as a chef. He gets to minus just the alimony, not the child support. And he also gets to minus his student loan interest. So these are called deductions for AGI. So his AGI is $37,850. There's no mention of any itemized deductions. You didn't see any home mortgage interest or real estate taxes or any of that. So as a single guy, he's going to use the standard deduction of about $12,000. These are for people in 2018, so the rates are a little different. So that gives him taxable income of $25,850. So his AGI is $37,850. His taxable income is $25,850. And then we would have to compute tax on $25,850. So let me show you how to do that. So let's go over here, and what we're dealing with is Roberto, and his taxable income was it $25,850? Okay. So if his taxable income is $25,850, make sure I have that right. I don't know what that is. Okay. Uh-oh, I just lost everything I typed. Oh well, okay, that's all right. You guys have it on your screen, so you're good. Okay, so Roberto, taxable income $25,850. Okay, so what we want to know is, how do you compute tax on that? So when you compute tax, you have to use the tax schedules, the tax rate schedules. They're called the tax brackets. And so a few of you have messaged me questions. Sorry about making this video today. I meant to do it yesterday and the day before, and it's just been kind of a crazy week. So, so here we are. Here are the tax brackets for 2020, but I actually need them for 2018 because I'm using 2018 for Roberto. So here are the 2018 tax brackets. And so you can see, so there was a question that somebody asked me about the marginal tax rate. The marginal tax rate is the rate that you live in, the row that you live in. So because Roberto, not Marcos, Roberto's taxable income was $25,850, he is in the 12% marginal tax rate. He is an individual and his income is between 95 and 38.7. So he's in the 12% bracket. That's called his marginal tax rate, okay? Average tax rate is what he actually ends up paying. So let's go to, I wanna see something that looks better than this. These are the rates and brackets and stuff, earned income. So unmarried, I just want it to look different than this. So here's the standard deduction for a single dude, 12 grand. Remember that? I'm gonna go to, I like the IRS's version of it better. This is Tax Foundation. 2018, what are the, just looking for something that looks a tiny bit different than this. Let's go to, there's all kinds of places that will give you the rates. And right now, I don't have your book right in front of me, and your book probably doesn't have 2018 information because I pick an old edition for a reason. 2018 instructions, let's do 1040 instructions. Instructions for, is this gonna give me actual instructions? It's because I'm looking for such old stuff that I'm having a hard time. But Form 1040, instructions for Form 1040. Now, when you guys do your homework, like the brackets are actually given to you. So I can just use 2020 instead, and that's fine. They give you line by line instructions on how to do your taxes. But again, I'm not going to have you doing that exactly. Really doesn't want that word, does it? Tax table. If you look, see how big this document is. I thought I could just scroll to what I need, but it's not coming to me as easily as I want it to. So it says if your taxable income is less than 100,000, you have to use it. If, however, don't use the tax table or tax if you have any of the following. Okay. I would just like the worksheet. Qualified dividends one. Oh, they have you do it this way now. Okay, that's why I'm having a hard time. Okay, I'm gonna just get out of this and I'm gonna compute it based on just this right here. Okay, so basically for Roberto, what would happen, not to stay big, that to be small. When we compute tax for Roberto, his first 9525 is taxed at 10%. So he has 25,850. So for the 10%, he will take 9525 times 0.1. And then for the 12% bracket, only the income above 9525. So his income between 9526 and 38,700 is taxed at 12%. So what we literally do is we take his taxable income of 25,850, we subtract 9525, and then we have to take that number times 0.12 because it's just his income that is over 9525. So his income between 9526 and all the way up to 38,700 would be taxed at 12%. So his total tax is 2,911.50. This is his tax. And then he would compare that to what was withheld on his paycheck to see if he owes or he gets a refund. So I think I remember that Roberto, so here's the formula, 952.50, and then 12% of the amount over 9525. So this is his tax liability. That's what he should have paid in tax. He had 3,100 withheld, so he's going to get a refund of $188.50. Okay, so this is the basics on how you compute tax. So from there, I went on to Marcos. That's Roberto's cousin, and he's a married dude, okay? He makes $45,000 from his wages as a master chef. He supervises Roberto. He has 4 children along with his wife who stays home. He pays student loan interest of $200. He had $3,400 withheld from his paycheck. He also had interest income of $300, and he won a church raffle for $1,000. So he had a good year, man. Okay, so this is gross income. This is going to be minus the student loan interest. This is what we'll use to see if he gets a refund or not. This is gross income, interest income, and so is the church raffle. The church raffle is not a gift, it's a prize, so it is income. So he made 45, 46, 300 is his gross income. We will subtract the 200, so his AGI is 46,100. As a married couple, his itemized deductions would get added up, but as long as they don't hit 24,000, he'll take the standard. The standard then is 24,000, no exemptions, so his taxable income is 22,100. So if we go back to that table, 22,100 is what I said. So for Marcos, he made 22,100. I don't know why I can't seem to remember that. Yep, 22,100. Okay, so his first 10% is up to 19,050. So 19,050 will be taxed at 10%, and then anything in excess is going to be taxed at 12%. So he's married, so that's why I'm using this number. So what I'm going to do is I'm going to take his total income of 22,100 and subtract 19,050 because the 19,050 has already been taxed, and then take that times 12%. So his total tax is 2271. Okay, so his total tax is 2271, and so what happens is he had withheld 3,400, so he's going to get 1,120 back. But there's something called the tax credits, and there is a $2,000 credit for each of your children under the age of 17. So Marcos and his wife are going to get, they have 4 children, so they'll get an extra $8,000 back. So we would actually add 8,000 to that, okay? And so not all of it is refundable. Sometimes it's not all refundable. Also, they might get earned income credit, which is a tax credit they can get. But here we're just trying to learn the basics, and so we can stop at that point. So then we have Tim. We can go through one more. Tim's a divorced, bitter man who works as a sous chef for Roberto and Marcos. Tim is one of my students that I'm pretty fond of. His wife left him, sorry, Tim, and he kept the two kids that he lovingly named Anthony and Adam after his college buddies. He makes $25,000 a year, but receives child support of 10 from his ex-wife. Not everything was bad for 10 because he won 5,000 at the casino and didn't turn around and blow it all on roulette. Okay, so Tim had 2,100 withheld from his paycheck. What is his taxes? Okay, so Tim made 25 grand in his job. This child support, not taxable. Child support is never taxable, okay? He also won 5, so we would need to include that. So now he has $30,000 up here. There was no mention of student loan interest or alimony paid or any of those things. So no minuses there. So his AGI is 30. Now, Tim, because he has 2 children, he actually qualifies as head of household. Is that over here somewhere? I know I saw it earlier. Let's click on that. So, you know, the standard deduction is 12 for a single person. What that means is if your income is under 12, you do not have to file a tax return. You probably want to, because if you had money withheld, you can get it back. You can also potentially write off your student loan or your education expenses. But back to this, basically, if you're single, your standard deduction is 12. If you're married, it's 24. But head of household lands right in between. And I was trying to pull it up, but it doesn't really want me to. There we go. So head of household, 18,000, like right in between. Okay, I had to bend forward to see it because my eyes are bad. Okay, so back over to here then. He gets to subtract 18 because of those kids. And so his taxable income is only 12. So if we're looking at Tim's taxes to compute his taxes, what we would do is, I don't know where it went. We would use those rates, and he actually has separate rates as head of household, but his rates would be pretty low. So he's not going to have to pay too much in tax because his income's pretty low. So he'd be in the head of household brackets. He would be in the 10% bracket. So it's 1,200. He had 2,100 withheld. So he'd get a refund of 900, and then he gets 2,000 per kid as well. So he'd get probably 4,900. So that's just several examples. And so what I want to do is I want to just make sure that I feel comfortable with what you're doing for homework. So hopefully you made it this far in the video. I know better than to make long videos because I know that means that sometimes people don't watch them, but I really wanted to help. So the chapter 3 discussion forums, I already looked at those and they're good. One of them's about like warranties and stuff, and one of them, I think, and then one of them is about like the new tax reform. So this chapter 3 activity is the one that students will struggle with the most. And so if you're in that category, feel free to reach out. But we have Mr. Smith, and he has several jobs and different things going on. So what I want you to do is I want you to identify his gross income. So look through and find out his gross income, and then you can find the standard deduction. I don't know why. You probably, like, the current year standard deduction is fine. I don't know what year it is. What year is it? So if you just want to use, oh, I guess you have the table, so it doesn't really matter. So it says we will assume that the standard deduction is 14. So you're going to use 14,000 right there. And go ahead and go find the standard deduction for him based on if he's single or married for the current year. So you can do 2020 there if you want. Find out his itemized deductions to figure out which one you want to use, and find his taxable income. Then you'll compute tax just like I was doing earlier. And then his marginal tax rate and his average tax rate. So to find an average tax rate, so marginal is whatever row you finish in. So whatever his last dollar is taxed at is his marginal rate. So if he ends up, I haven't looked, if he ends up making $200,000 of taxable income, then he's in the 33% bracket. So that's his marginal rate. I don't think he's there, but whatever. The average rate, what you do is you take total taxes divided by taxable income. Okay, that's how you get an average rate. Okay, and so from there, I think you'll be fine to go through this stuff. And there's just some basic information and questions about taxes and stuff. So I think you're going to be good there based on what we've done. What else do I want to share with you? There is some, we usually spend some time talking about like whether your parents should claim you on their taxes or not. And so there is a tax credit available to your parents or whoever claims you on the taxes. So the person who claims the person is the one that gets the tax credit. So if you are an adult and I decided to go back to school right now, okay? So as a 41-year-old, if I'm going to school, I claim myself because I'm a grown up. So I would get to write off, basically it's 100% of my first $2,000 in educational expenses. And then 25% of my next $2,000. So it ends up being a $2,500 tax credit. So I would get to minus 2,500 from my tax bill, not from taxable income, from tax. Remember how when Marcos had those 4 kids, I got to add an $8,000 refund? I'd get to add a $2,500 tax refund. So whoever claims you gets that money. But for most of you who are traditional college age students, if you don't have income, then you don't get that refund. So if you don't have taxable income, only 40% of it is refundable. So that means instead of getting $2,500 added back to your tax return, you would only get 40% of that. So you'd only get $1,000 added back to your return. So would you rather have 1,000 or would you rather have your parents have 2,500? So it's better, you're usually better off to let your parents claim you. There are rules for who claims a dependent, but if you are a full-time college student, your parents still can claim you regardless of how much income you have. So if you've got questions about your personal situation, I'm always glad to talk through those with students. But do understand that almost always financially, you're better off letting your parents claim you. I had sat down with several students and like they were working enough that they really were independent, but if they let their parents claim them, then it benefited their parents more. And then I just had them like compute both so that the parents could see what their tax return would be, and they kind of negotiated how to settle that. But if your parents are taking care of you, then dang it, they need to claim you, okay? And so don't worry about that. If you're taking care of yourself, then there's a decision to be made there. So, okay. So it's really good to see you guys. I hope everybody's doing well. Quick update here. Puppy comes home next week, next Wednesday or Thursday. So I would like to end with, not that, when I'm cleaning, I always find weird things. And so this is my middle boy, but look at her. She still doesn't have a name, but we have several names that we're discussing, and I think we're getting a little closer. So I hope you guys are doing well, and I hope everything is great. I hope you guys have a good week, and let me know if you have any questions. I'm always here for you. So take care of yourself. Thanks.